and thank you very much for attending this seminar, everyone out there. My name is Michael Gobitschek. I'm the lead manager for SKAGEN M2. This is a global real estate fund investing in listed real estate. Most of you already knows about that, but I think we have some newcomers as well. We have a lot to cover today. I will start just to mention that all the numbers you will see, performance numbers, etc., is in Norwegian kroner. I lost the other euro presentation, but don't despair. I will send it out this afternoon or later on with euro numbers, so it doesn't change the picture that much in relative term, but of course a little bit worse outcome in absolute term. So let's go on with the presentation. We have a lot to cover here. Where are we now, or at least in the beginning of October? If you look at the big real estate markets, let's start with the non-real estate market. On the left side is the black bar. This is the MSCI All Country World, meaning all sector except all sectors. And it's up 20% in Norwegian term, which is about 90%, 19% ahead of the real estate benchmark, the MSCI All Country World real estate. SKAGEN M2 is up 7%, which is about 6% ahead of the benchmark year to date. And if we're moving on the right of this scale, Europe is actually in positive terms as of beginning of October. And remember, Europe were had a bad outcome in terms of performance last year. Even worse was the Scandinavian real estate market, with Sweden as an engine, down almost 45% in Norwegian terms, and it has continued to go backwards this year. And one has to remember, this is one of the most severe real estate crises that we have had in a long time, with the exception maybe from the grand financial crisis and the small dip we had in COVID, but the recovery came very quickly. So I want to start to remind everybody, this fund, SKAGEN M2, is about diversification. We will not maximize risk to every cost at every time. This is about diversify in geographies and in subsectors. Both are equally important. This illustrates a boom and bust scenario. We had a fantastic year 2021 in Scandinavia, as we had in the US. For that sake, it was a record year. 2022 was not that good. And 23 has also been a little bit worse for Scandinavia benchmark anyway. So this illustrates 1,000 Norwegian kroners, could be any currencies, of course, but with a different outcome. On the darker blue bar, it's SKAGEN M2, and the lighter is the Scandinavian real estate index. So we had a boom. Everybody wanted to join the party, unfortunately, at that time. Which is, I think many people didn't step off the train at the right time, so they follow in 2022, just waited for the occasion where everything was supposed to turn, and then have not left the train since then. So with this said, I think Scandinavia starts to get somewhat interesting to look at the moment, but one should be very careful putting all the eggs in a geographical basket or a sub-segment basket, because there are different dynamics, there are different currencies, etc. You're all professional investors. I know that, you know about this, but despite that, many people are going for the real estate on the spot they're standing, meaning in their home domestic country. So this is worth to bring with you going forward. We have the boom and the bust, so this is a good lesson, I think, to learn from. We have seen this a lot in real estate market. Okay, we have suffered investing in real estate since COVID, actually. This is after COVID, after the boom year of 21, entering 22. This has to do, of course, with inflation, fear of further central bank hikes, fear of the economy as a whole, especially in the US. Will we have a severe recession? Will we have a soft landing? In Europe, we have more war fear. We have fear of too indebted real estate companies. Will there be any buyers on disposals? Will we have further equity raises? Will we see further dividends that are halted, etc.? This has affected Europe and Scandinavian market. In Asia, we have seen Chinese real estate market that has been collapsing as we speak. We have also seen the recovery of China as an economy has been slower than expected, has weighted on the Asian market a lot. So all these things has made the real estate market performing worse than the big market or the general benchmark. This is nothing new, but what can turn this? Well, in today's sentiment, it's basically all about interest rate. But that's not the full truth, and we know about that because growth is also a very important component of all sectors, but also real estate, of course. But I would say the day that when we can say that we have probably reached some sort of interest rate peak, then this will turn, and it will turn very, very fast. How does it look in terms of valuation? Well, we look at this, we have seen it before. On the top graph, we have the net asset value or the substance price versus price to substance. This is an aggregated picture, and it's now trading on a global basis on 22% discount, which is lower than the 30-year average, which is 10%. This is, of course, masking big differences. As always, we have US trading at a 10% discount, Europe as a region 35% discount, but Germany, that part is trading at the 55% discount. So there are a lot of differences geographically, but also in subsegments where you have logistic, for instance, trading in par with substance or net asset value, while you have offices trading at 30, 40, 50% discount depending on leverage, etc. So market is here telling us that real estate values will come down further as we speak. That's what the market tells us. If that's the outcome, we don't know yet. This will ultimately depend on the interest rate curve going forward, and then we move down to the lower graph. This is a implicit cap rate or EV/EBITDA in this case, also aggregated, masking big differences in geography and subsegments. We are up at almost 6% cap rate at the moment. So we have climbed pretty steep from where we saw the low yields or low cap rates a couple of years ago. This is lower than the 30-year average, but one has to be reminded of the high interest rate that we had in the beginning of the 90s, but also we had low interest rate a couple of years ago. But the average here might be a little bit too high, but it's a semantic question, right? Let's see what's happening. And it will be decided by where the interest rate will settle this time. This is a bit offset as well from the inflation adjustment. I will just mention that because that's a very important characteristic in what we're doing with real estate. We have the inflation adjustment, but it's working in different ways, in different subsegments and in different geographies. We might come back to that. So anyway, 5.9%. So if one believes that we have soon reached the interest rate hike period for this time or reach some sort of peak, it might be an interesting time to get a position. I hear myself like a parrot because I know I have said this before, and I really thought that we would reach that point earlier or this year actually, but now we have postponed all these movements. Market thinks about first half next year, and nobody knows, but I think we are closer to our interest rate peak than we were before. But a lot of things might happen from this point where we stand now. But again, it might be an interesting time to take a position. Looking again at the valuation, but this time we break it down again to Europe on the left side. This is grand financial crisis, COVID, and last 12 months. So as we can see, we have a pretty depressed valuation on the stock market, even though it has actually come up a bit. Why is this? Of course, we have a war, we have a slow growth, etc., etc. But one main point here is that we have much higher leverage. On the right side, you have the bars in the companies in Europe and especially in Scandinavia. And we have all read about that over the last couple of years. The good part here is that companies has actually succeeded to deleverage in terms of selling off assets, raising capital, and the bond market is actually not dead yet anyway, but it has actually started to defreeze a little bit. We have seen some interesting bond issues in Sweden, which has been the most severe market, I would say, on the bond market side. And interestingly enough, you can compare European leverage, which is 11.5 times now, with what was in 2 years ago, it was 14.5. So it's actually coming down. Leverage is coming down, but still twice as much as US, for instance, in terms of leverage, but they have a REIT system which not allowing as much leverage as you can do in Europe, for instance. But still, this is punishing the real estate market as a whole in Europe. So what will turn this around again? Now we have rhetorics every day almost with higher for longer. We have heard it before, but then it was lower for longer. So that's the market sentiment at the moment. On the left side, we have inflation expectations from consensus economics, meaning it's 200 sharpshooting economists that has made their best guess. Probably not be right, but still it's the expertise. So we have the outcome already for September because this has a couple of weeks. It's old. And we know that Europe, for instance, came in with inflation of 4.3, so a little bit lower than expectation, and US a little bit higher than expectation. So what is interesting with these numbers? Well, for me, doing real estate, global real estate, this is interesting because if we look at the US numbers, for instance, they're specific and not the same as the European numbers, but the US numbers, if you look at inflation, the CPI contains of 34% of shelter, and shelter is rental and rental related pricing. If you look at the core CPI, it's 44% of the index basket. So it's a huge component in the US inflation accounting. To provide an example, in August, for instance, 70% of the inflation in US were shelter, 70. And we see the curve is coming down with a lag, as it was a lag when it's coming up, meaning the inflation didn't hit the numbers before after a while, as much as they don't hit the numbers when they come down. But now they are really on their way down because we own multifamily housing and rental apartments in the US, so we can see this as we speak. So this means that the inflation is fast coming down, or the expectations of that anyway. We have heard that before, I know that, but hopefully they will have right this time, more right than wrong, because ultimately you can't raise the interest rate too much before you break the back of the economy, and I think the central banks are really aware of that. In Europe, we have other problems, but still it's interesting despite all. And looking at the right side, this is the five interest rate hikes period in the US, counting back to almost 89. Has been very rapid rises in interest rates, but also rapid decline in interest rate. This is no prophecy. This is just history in what we might learn something from it. The exception here is from 94 to 99. We had more or less a flat development, but still, jury's out. A lot of bad things might happen. For instance, on the inflation side, energy might be the joker. That is really a nasty one. And war and oil, for instance, is a bad combination, or the oil price. Let's see what's happened, but this is what can turn the sentiment now, because the sentiment is so driven from the interest rate. And we know what's happened when eventually we reach this peak. We have seen this before. We can do it in many different countries, and the pattern is the same. Initially, when they start to hike the rent, real estate is not that funny to be stuck in, and we know that for a fact, because people are discounting. Oh, this is a capital-intensive asset class. With some are really high indebted, and some maybe don't have inflation adjustment, etc., etc. So we leave that space. Same thing during the interest rate hike cycle, but they still get return. In this case, it's US, so it's the dark blue bar are listed US real estate, and the light blue is S&P 500. So you typically get the dividends anyway, and you get some return. But the beneficiary period is, of course, after, and the market is discounting that, okay, we have reached the peak and we might go down. So this is perfectly natural in a real asset class that we are in. And also probably recessionary environment or recessionary-like environment. We go back to the early cycle driven by all the stimulus from central banks, i.e. looser monetary policy, or government spending to stimulate the economy. So that is actually the prime time for real estate. I'm not sure when we reach there, but I think the key here is and what one should look out for is the signals for the interest rate at the moment. But don't forget the growth, because that is also important, both for housing prices, commercial real estate, etc., etc. Let's move over to the fund. We are at beginning of October, or month end. We are ahead of all metrics in terms of time. And this is again in Norwegian kroner. We have delivered 8% net of all fees in the share class A, which is the retail share class, since inception, despite being in the middle of one of the worst real estate crises that we can remember. So we're pretty confident with that and hope that we can produce even better numbers in absolute terms going forward. This is about diversification, I said, and this, I think, monitors the way we're thinking about the different subsegments. On the right side, we have the resilient steady earners. You might recognize some of them, but we have here, for instance, companies that are driven by strong secular trends. Data centers was driven fantastically by the AI boom, or artificial intelligence boom, and will be driven by the demand that is arising from artificial intelligence. We have logistics that are still in a nice growth path. We have student housing, healthcare, more stability, and we have more boring self-storage, which is strongly cash flow generative. On the left side, more of a risk, so it should produce more alpha when they started to move. We have hotel, office, CBRE, it's a real estate consultant, etc., etc. And even we have some emerging market housing developers, small positions, but they are a little bit more risk. Top 10 names is 45%. We typically are around between 45 and 50%. One might think is a little bit strange with Norwegian position of 7.5%, but luckily we have a pending bid on self-storage group, which has taken up that position somewhat. Otherwise, what one can say on this top 10 position is that it has a very good position for a potential yield curve shift. Nowadays, we have this strange situation of, if you look at the 10-year bond in the US, it's almost 5%, but the stock market is continuing to go up, and that's a very strange situation. But the time when or if the rate of the yield is coming down, we are very well positioned with this portfolio. But we have succeeded fairly well, even though we have this portfolio that is tilted a little bit more versus digital real estate, which has a little bit more in embedded growth profile in the future, for instance, data center and some others, which has higher multiples. So we have still succeeded very well with this portfolio, but we are very well positioned the day when the yield will come down. Good sub-segment exposure. We don't have that much office anymore. We have offices in the place, offices still working, meaning not in USA that much, like New York and San Francisco. We have been there, but yeah, we might talk about that later. We have overweight in digital infrastructure, as I mentioned, residential rental, but it's an unregulated market because you have a lot of trouble today in the regulated markets because the interest rate is higher than the yield actually in some cases, and that's not a good equation. And high exposure in logistics and warehouse as well. So have we succeeded in finding the right companies? Yes, we have, and this is the proof of that. The light blue bars is the stock picking ability year to date. We have not been as successful to estimate or to try to guess how the currency will move. So we have a negative outcome this year on currency, and that's the dollar. And allocation is slightly negative as well. So if we look on the longer term, 3 to 5 years, stock picking ability is very good, even in the longer term, but the currency and allocation has not been that good, especially the currency, because we were heavily underweighted in US, especially after 2021, where we had average cash flow multiples on the US benchmark of about 25, 26 times. We thought that we're a little bit exaggerated, so we took down the US exposure and put a lot of money in Europe. Then the war came, but we were overrun by a very, very strong dollar. So the currency effect here was a little bit negative over this type of years. But the most important for us is that we find the right companies, even though we might be in the wrong markets. Today we have about 37% in the US versus our benchmark is 60%. As you can see, this is active management, and that is actually what you pay for. Otherwise, you should go looking elsewhere for a cheaper fund. And that is the stock picking ability you're paying for, and that's the long-term spectrum we are looking at, because active management means also that we are not always the right position. So this is the worst and best performer this year. Said before, if you look at the left side, Self Storage Group has there is a pending bid on Self Storage Group. We have been invested in this since 2017 and have hoped for a takeout on this small pearl that we had in Norway. We have waited a little bit too long, but during our waiting time, meaning since 2017, we have had an annual return of 18% annually. If the bid is successful, it's not 100% clear yet. But this is what I mean with active management and stock picking, because we have been digging very, very deep in this and digging very deep in this sector, because we have seen the consolidation going on, especially in Sweden, where this huge American pension scheme is consolidating the market, and with the acquisition of Self Storage Group, they will have a market in one throw, so to say. So you need to have a patient, and you need to be active in turning the stones. So eventually, hopefully, the thesis will come true. Otherwise, what you can see here, it's a good mix among sectors and geographies. Interestingly is that, just to mention, 1 year ago when I was holding the seminar in October, I think it was last year, Self Storage Group was the worst performer back then that year. So a lot of patience is required. Okay, we talked about Scandinavia, and we started to do that as well. And I just wanted to highlight this slide because I constantly hear that Scandinavia is something that the foreigners don't like and hasn't done so for a couple of years, with right, because it has been and is very leveraged companies, dubious cross holdings, and other things that it's hard to control. now I think I had a seminar before before this one, and I was asked about Sweden and exposure, and you can either think this is a bad exposure to have, or you can think like I'm leaning at, this is very interesting times to fish in this water if you're careful and know what you're doing. So why is this interesting, Scandinavia and Sweden? Because it has taken a severe hit already. We have seen since the outbreak of 2022, basically after a good year, Swedish real estate market has almost halved. Came from a high level though, but if compared to the OMX index, the general benchmark in Sweden, it has just lost 24%, so it's a difference of 27 percentage points. Looking at the valuation, top right, we are back to, if you look at price net asset value or price substance, we are back at the grand financial crisis levels, which is not exaggerated, I think, anyway. But what is the market telling us? The market is today telling us that the implicit value loss of real estate will be another 15%. We have already lost 6 or 7% with the new reports coming in today. Let's say 7%. So we will lose another 15%, meaning we are ahead of 20% value loss from the real estate. Put this in perspective, we look at the 2 other meltdowns that we have had in a year since 2000. 2001, 2003, Swedish real estate market lost 9% in total before the turn. The other one was the grand financial crisis between 08 and 09. Swedish real estate market lost 12% in total. So today we have lost 7, but the market is pricing in over 20%. That might be the case. I don't think so. I think it's too much in the price already. So what have we found since we are talking about Scandinavia? We own Catena. I think that's a beautiful company. We have owned it since 2014. Stable and solid balance sheet with a lot of cheap land banking. They can build for a good yield on cost on 7%, which is basically at least 2 percentage points higher what they can lend at. So we have a positive, accretive project portfolio. We have Castellum on the right side. This is the beta name. This is where the foreigners will end up the day when they think Sweden is interesting again. And Norway also, by the way, because they hold a position in Norwegian Entra, which is a interesting company as well. We took part in the equity raise in Castellum, which was the largest one ever in Sweden in the real estate market, raising 10 billion. So we actually took down the financial risk very much. And the risk today isn't the financial one, I would say. It's the operational one in that, if you say so, because if the economy goes down a lot in Scandinavia, Castellum will feel that, of course, with net letting, etc., and higher vacancies. But Castellum is an interesting beta name, and to play this market, they will be beneficiary the day when the interest rates are coming down. Looking at in the middle, that's actually what I wanted to talk about. Diös, it's a small niche player. Probably the attendants outside of Scandinavia have never heard about it. It's a niche player in North Sweden with assets of about 31 billion in a location in metropolitan cities like Skellefteå, Luleå, Umeå, Östersund. Probably many of you have never heard about this, but this is a very interesting region in Sweden. The Swedish government estimates that they will invest about 1,000 billion Swedish kronor. It's about 100 billion euros over the next 10 to 15 years. And where will this money go? Well, this is the place for the green transition, the fossil-free steel, the battery factories that is thrown out in the middle of the woods outside of Skellefteå have invested about 4 billion euros already, etc., etc. Solar parks, wind parks. So this will drive and is driving, because these cities are growing. We will see estimated numbers of over 100,000 people moving up to the north because they have a lack of labor and etc. etc. DS is perfectly well situated there, and they have also really nice assets within these cities where they can also continue to hike rent. So they're standing with both legs fairly stable as is, but you have this strong trend driven that drives north part of Sweden. So this will take some time, but it's an indebted name, and they will have some maturities that is coming out now, so they will have to refinance. This is all in the price. It's trading very low, and maybe we might see if the things get worse, they might raise some equity or not. But it's an interesting name, and we have a small position there. Talking about balance sheet, this is the prime slide that we always show. We sleep well at night. We have an interest coverage ratio of 5.2 times. We have a loan maturity of 5.4 in average in the portfolio. We have fixed or hedged debt of about 70% in the portfolio, and LTV of 35%, or even better metric with the 82% net gearing. We are cheaper than the benchmark. Now it's a little bit more expensive than last time we met, because we have more of this digital real estate, which is trading with a slightly higher multiple, but still we are a lot cheaper, except from the dividend yield, and all know why, because we are investing in a lot of real estate that recycling the money into the business instead of just handing them out to the investors. We have those as well, so we are having a 3% dividend yield instead of 4.1. So on the other hand, we have a higher earnings yield. Just to sum this up, fundamentals likely to get worse, yes, but we know about this already. It just depends on how much worse, because all the estimates now have, or we know that the profit and loss will suffer due to higher interest rates, and we know that we have inflation adjustment in one way or another. This will not fully compensate, and you have some time lag. So if and market is now assessing a certain, depending on where you look, number of rental interest rate hikes, and that is also in the price today. So it's just those new potential surprises that might spoil the party, as we have seen during the year. But again, I think we are likely to see interest rates reaching the peaks or starting to come down soon, rather than the opposite. So, and that's my message here is, I think it's wise to position before that is happening, because then things will move fast, that we have seen before, just on small inflation numbers coming through. So if one think it's a good way to position now before that happen, if it's happened, we can offer in SKAGEN M2 strong cash flow, strong balance sheet, a lot of hedged debt at the moment, 70% in the portfolio. We are cheaper than a benchmark. We are in sub-segments that are hard to get in the local markets. And we are well positioned for the yield curve shift, as we hope will eventually happen during next year is the most likely. So I see I'm moving over time here, and I'm happy to take some question.
Thank you indeed, Michael. We have a question for you, and the sender would like to know, if markets starts thinking that interest rates are not going down but going to stay at this level for the coming years, what do you think will then happen with real estate prices?
That's a good question. I think if the interest rates will stay at this level that we have today, because market hasn't started to, not in my way to see it, market hasn't started to discount a much lower interest rate, rather the opposite at the moment, because we have now talked about lower interest rates for 1 year, and we have seen disappointing numbers in inflation. So we have month by month postponed this interest rate peak, with a couple of exceptions along the way. But now it's really, we will have higher for longer, and that's what we see as we speak in the price. That is one point. So you have a lot of air in the prices and valuations at the moment, I would say. And the market, and as I said, I mean, the market is pricing, for instance, the Swedish real estate market, as they will lose another 15% from here. And I think that's exaggerating, because we will have the inflation adjustment on top, creating value. I mean, you have the interest rate on one side, both in terms of higher costs in the profit and loss, but also increased rate of return. That is destroying value. On the other hand, you have the inflation adjustments that we have seen, for instance, in Sweden, 10.6%, is creating value through higher cash flow. Ultimately, what will happen is, if we have an economy that is better, I think values will actually come up. If we have an economy that is much worse, because some of the pricing today is pretty recessionary, especially in Europe and Sweden, prices will continue to go down if we have a poor economy, because then we will see further vacancies. We will see tenants starting to negotiate this inflation component, like, I don't want to pay another 10% this year. I give you 5%, but on the other hand, I stay as tenant. Otherwise, I will lose. I will break my contract. And of course, they take the 5% instead of 0. So that we will see. The scary thing is if the interest rate is continue to go up, because then investors will continue to adjust their required rate of return. We will see fundamentals are harder hit when they are refinancing, because remember, some companies are having the maturities in 8 years from now. So they're actually earning a lot of money because they get the inflation adjustment, but they just paying the low rents, right? So it's the ones that are refinancing their debt now that are suffering the most. So this is, for me, a question of economic development, and further, what will drive the inflation? For me, from now, it's just the energy prices that are some sort of derivative from an escalation in the war. I don't see the inflation turning from this path that it has started, both in the US, in the Europe, in ECB, and I mean, we will eventually also end up with a interest rate peak even here in Scandinavia or in Sweden, where they are at most hawkish rhetorics. So there is a lot of paths going down the road here, but I think eventually, as long as we have some sort of growth in the economy, real estate will cope fairly well. And we have seen transactions I mean, perception is Sweden is the worst market now, right? But I talked to those people doing real estate, direct real estate, and transaction and bids. Some assets you have 10 to 20 bidders as we speak, despite being a very nasty time for real estate. So it depends on also quality, etc. But there is no blood on the street that we might think when we read about things in the papers. Not if I listen to those doing the direct side anyway. And I mean, stock market is pricing in 20% downturn in Sweden, and I think that's not either the case. Because when the market is thinking that interest rates has reached some sort of peak, things will turn fairly fast if the economy is fairly healthy. That's my opinion and strong belief.
Brilliant. And last question, and please keep it short. Another question from Ronald. Can you please elaborate a bit on residential real estate market in Europe or UK? What are your expectations moving forward? What will happen to the demand, supply, rents, etc.? Do you have any insights?
No, I have opinions. Let's start with UK. UK is if we look at the rental side, not the sell side, meaning you build and sell. If you build and rent out, that is where we are, and own Granger, for instance. There are a lack of supply in UK, especially if you look in the bigger cities, and especially in London. That's why we have focused a lot on Granger, which has this also strong collaboration with the subway operator in London that has a lot of interesting land bank in the middle and outside of London, where you can actually build rental residential. But the dangerous thing talking about rental residential, like we have in Sweden, Germany, Finland, not Finland, sorry, Sweden, Germany, and other countries, Denmark, for instance, is the rental regulations, because you can't take out top line how much you like. It's not the demand and supply mechanisms that are working. And that is a good thing if you have a capped downside, meaning that you have no interest rates, because there are no interest rates like we had a couple of years ago. And for instance, the German real estate players, they had their 1-3% growth, and then you paid no interest rates. But today, when you pay 4 or 5% interest rate and you still have this capped upside, it's not a very good equation. Still, you have a lot of value in those names, but the cash flow is suffering at times when you have these high interest rates. So I think my take to you, Ronald, is there is a reason why we have left, and you have been with us for a while. We have left, for instance, Germany and Sweden, which we like those markets in that environment we had back then, and now have moved over to unregulated markets, because then you have the supply and demand, and typically when you have bad times like we have now, very, very expensive to build new apartments. Nobody do that, because especially not in regulated market. But if you have, like in US, for instance, you have a demand side, you can do the math and actually earn money still on that. But you have this supply and demand, and as long as that is in place, and also for people to buy nowadays versus 2 years, everything talks for rental, because it's much cheaper to rent something today than to buy something, which was the opposite just 3 years ago. So watch out for regulated markets. I know they are cheap. We have a lot of them in Sweden. Yesterday we had one raising capital, but check the rental costs and check the interest rate cost, and check the rental dynamics in each country, how that works. That's my short answer.